Hi, everyone. Welcome to the Getting Sharp podcast presented by Omega Point. I'm Omer, CEO and founder of Omega Point. And for the community, we've created this podcast to really help you quickly understand some of the most relevant topics impacting institutional investors in the current market environment. Today, I'm joined by a very good colleague, Krishnan Sadasivam from Quant Insight, who's going to provide us a view from the market on from a macro-driven lens. As many investors today are grappling with potential Fed rate cuts, possibility of a recession versus a soft landing, upcoming U.S. election, what else, right? So many things to do, but these are very top of mind, and these issues obviously dominating the discussion amongst portfolio managers in our community. So to help our investor community make sense of all this information, Krish and I will be breaking down these macro risks using Quant Insight's new returns-based risk model. And so really interesting model here. We want to get into the details of that. But, we want to use it to answer some of these questions, right? We want to understand how different sectors are going to be reacting to some of the factors that they measure in their model, and really take a look also at the Mag 7, right? How do we think they're going to behave, and what has adjusted those Mag 7 over the period of time? So with that, like to formally introduce Krish from Quant Insight. Krish, thank you so much for joining me today.
Hi, thanks so much. Great to be here.
Absolutely. Very happy to have you here, and obviously been great working with you over these years. You guys have continued to innovate in the macro space, which we're very excited about, and you have a new risk model, which is a returns-based model relative to some of the prior models that you've had. I'd love to hear a little bit more about that model. Why don't you give our listeners a little bit of background and how it's constructed, and just so we can have a foundation for the questions that we'd like to answer.
Thanks. Yeah. So the critical thing about this is it's very much a risk model in terms of the outputs that you get. So you'll have returns attribution, loadings or exposures, and risk attribution. But there's one key difference. So although the outputs are going to be very similar to what you might see from a Barra or an Axioma, the way we get there is different. We look at time series data because we start off with the macro factor returns themselves as a given. So the moves in the macro factors themselves are a given. That's not what we're trying to figure out. We're trying to figure out the exposures of the stocks. Therefore, we use time series, unlike Barra and Axioma, who take the exposures of stocks to their factors as a given, and therefore do cross-sectional analysis to work out what the factor has done on a day-to-day basis.
Yeah, I mean, it makes sense. There's, not one size fits all approach to building a risk model. And I think that if the exposures are given in advance, cross-sectional approaches make sense. If the returns are given in advance, a time series approach makes sense. So it makes, I think helps everybody understand, every security, right? Obviously, you're deriving its exposures from a time series model, but obviously combining them in a way that still allows for the attribution, right? Across all the different factors to be orthogonal to each other.
Exactly. We're responding to how our universe works, which is the macro factors move, and therefore their moves are given. So we have to determine the exposures.
Right. So hopefully for the listeners, that's a good foundation to think about. Okay, we're looking at macro drivers, but you could still think about the security movements and the returns to still be broken down into all the subcomponents, right? The macro factors, there's still an idiosyncratic component associated with that. So it's very much still feels like another, a traditional risk model decomposition that people look at.
Absolutely.
Yeah. And so with that said, now that we can kind of think about that, let's kind of change sort of the lens and say, put this lens on what we're looking at and what are some of the questions that our investors are grappling with, right? And in particular, as I said earlier, right, people are obviously focused very much on Fed rate cuts, right? Maybe the number, the magnitude, those are still going to be somewhat uncertain. Right, the economy, are we moving into a recession, or is it going to be more of a soft landing? And of course, naturally, sort of the U.S. election. A lot of how macro topics are never typically thought about is qualitative, right? I mean, there's naturally some quantitative approaches, but really before your risk model came to the market, a lot of them were very much kind of qualitative overlays. So since you have created such a great quantitative framework, can you please walk us through which factors can help investors understand their exposures to these types of risks?
I think we tend to think about factors in three different groups. We look at the economy and inflation. how is growth happening? What are the implications of pricing? We also then look at financial conditions, which is where Fed policy comes in. We look at real rates, the dollar as well in terms of financial conditions. And then we look at risk. So things like the gold-silver ratio or emerging market credit, CDS, and so on and so forth, to see what are some of the things that might trip up the market in the future. So those are really the three key things we look at. In terms of Fed policy that you're talking about, there's been a lot of talk about it, but what we've actually found is that a lot of the impact of Fed policy has kind of already happened, and the market is somewhat less sensitive to Fed policy going forward from here than it has been in the recent past.
So specifically, if I were to take, for instance, you just even kind of whether it's the U.S. The S&P 500, right? Can you help the reader sort of think about or quantify with respect to that, or with respect to some of the more common sectors maybe that we're thinking about? Where has maybe the sensitivities been recently, where a lot of it was sort of still kind of an uncertain, and where is it today relative to recent past?
So I think there was a lot of if you like, asking for more policy easing. But if you look right now as to what's very sensitive, it's utilities and real estate. Those are the two sectors that are very keen on more easing from Fed policy, both in terms of the quantity as well as the rate.
And really from a perspective of, helping people understand high level magnitude, I think investors typically think about it sensitivity wise, right? If there's maybe a 1 standard deviation move in a factor, right? Or 1% move in a factor. I think you guys kind of think about it probably from the perspective, maybe a 1 standard deviation move in maybe in Fed rates relative to they are. How do you see utilities today and real estate position, just for the our subset of readers or listeners who are investors in those spaces?
Yeah, so you're looking at a 0.2% move if you have a 1 standard deviation move in Fed rates for utilities. That's the most sensitive. So that's actually quite a big move because the expectations are kind of tend to move in a slightly jerky fashion. So 1 standard deviation is not an awful lot if we get a policy change. So that's for utilities, and that's much, much bigger than pretty much everything you see out there. Real estate, for instance, is less than half of that in terms of its sensitivity to Fed rates.
Fantastic. Yeah, I think magnitude is really important for our investors, and as is it for everyone. And I think it's good to see at least that maybe other sectors at this point are not as concerned about it, but the subset of investors that care about utilities and real estate are probably still very much focused on it. It's nice to know that this type of factor can help them truly quantify what that looks like. So, in terms of, other broad factors, if we were kind of look at also, obviously, you mentioned, factors underlying risk and certainly factors underlying GDP growth or the recession. Can you walk us through some of those factors and how and which sectors you find more or less sensitive to those?
Yeah. So what's happened is that factor sensitivity to a future economic growth has picked up significantly. And so what we find there is that we had dropped off for a little while worrying about the economy, and now we're worrying again in terms of future growth. So if I look at forward growth expectations, retail sector really stands out as something that really wants future growth to happen. It's not a huge amount, but it's going up, and you're looking at about around a 0.1% move for every standard deviation up on forward growth expectations. And again, real estate shows there as well. So real estate wants both easing as well as a strong economy. I think both of those make some sense because strong economy is kind of the driver of sales for both of those sectors.
No, it makes sense. And just to dive a little bit deeper into forward growth expectations, can you just walk our listeners through what types of instruments or underlying time series variables are used to construct those forward growth expectations?
Absolutely. So forward growth expectations, we use the 530s curve, and we find that that gives an excellent indicator of future growth expectations from the market. So it's really about the steepness of that curve, which tells us what the market feels is economic growth in terms of future.
And if it's obviously, if we're talking about a standard deviation move, right, it's usually has to do with the underlying move in the 5 to 30s. And right now, if it's more of a flattish and it's moving more steep, you can see multiple standard deviation moves, right?
Exactly, sir. Yeah, this is very important. So although the numbers you might be hearing are quite small, I think the way you have to think about it is versus history. So we've seen a real pickup recently. The sensitivities, it looks like it's going to get stronger. But more importantly, I think you just have to look at it on a relative basis versus where the sensitivity has been. And it is relatively high compared to where it has been in the past.
Yeah. And again, as I'm sure many of our investors know, when you're in an environment or where you're somewhere where you're kind of in a flat situation and you're moving to more of a steepener, into a steep type of a situation in these curves, again, from a standard deviation, mathematically standard deviation perspective, that could be multiple standard deviations and it's perfectly fine because it's just moving into a higher sort of, regime. And so just to kind of understand, I think we could see easily, if obviously the economic picture improves and the curve continues to steepen, probably at least 2-3 standard deviation move based
Absolutely.
on. Yeah.
One of the things with macro factors is they often tend to go through the zero line. So the curve can be inverted and has been inverted in the past. So when that goes through the zero line, obviously the standard deviation becomes quite small or has the potential to become quite small. So I think we just have to be careful that we understand that as we move forward and look at these sensitivities.
Wonderful. No, it's very helpful and obviously gives that kind of context that we're looking at. For just a moment, for everyone's edification, there's also obviously the geopolitical and a U.S. election. That's not obviously necessarily a traditional time series factor that people track, but maybe you can help us understand how you guys think about it and how you may have incorporate the U.S. election into your insights.
Absolutely. So we use betting odds. This is a slightly different model that we use, but it's still quite helpful in terms of getting people to understand how betting odds are impacting the markets. What we found is there wasn't that much in terms of what the election odds were doing until about a couple of months ago. So just when we started getting the news about the potential change of the Democrat candidate, we had a big pickup in sensitivity of the market to betting odds. And what we found is that the Trump betting odds began to have a much more positive impact on the markets. So what we've seen is that as Trump's probability of becoming president has gone up, the markets have quite liked that. That's come off a little bit with the settling down of the change in the Democrat candidate, but it's still very much the case that a Trump election victory would be positive for markets.
And this is sort of looking at it more broadly, right? I mean, you can obviously look at it at an instrument level, but you're thinking about it maybe in the context of, let's say, the S&P 500.
Yes, this is for the SPY.
Got it. Yeah, and again, obviously, the nice thing about this framework and interest rate, right, because it's sort of a time series type of a model, right? You can look at these types of historical time series, and as they become more sensitive, you're picking that up, right? You're picking those up, and you can essentially overlay those into your model.
And the key thing we're doing is orthogonalizing, so you get exactly the impact of the factor.
Absolutely. Very helpful. I wanted to sort of, move to another topic that I think everyone it's sort of the white elephant in the room. Whenever you talk about the markets, you're asking yourself, well, is the market really, at S&P, for instance, the 489 other stocks, or is it really just 11 or 7 that really matter right now in moving the markets? What we've noticed, obviously, in the early part of this year and going into mid-year, the Mag 7, right, was basically the market. But what was also interesting is we saw a lot of idiosyncratic, right, or sort of these risk models saying, well, actually, this is not really, their moves are not really explained by traditional sort of factors in the market. Curious from the perspective of your model, right? How has the Mag 7 evolved over this last, month, 2 months, and even throughout the year? And what should investors be thinking about in terms of the Mag 7 sensitivity to sort of more betas and factors versus continuing to maybe drive with their own idiosyncratic alphas, the movements of the market?
Absolutely. So what we saw is three clear regimes since the bottom in last October. The pop to the year end last year was all macro. It was very much driven by macro factors, and that got the market and Mag 7 up to the start of the year. From the start of the year, for pretty much the entirety of the first half, apart from a wobble in April, it's really been idio. And then suddenly, almost literally from the start of July, it's been macro again. And what you've seen is idio has flatlined in Q3, and it's all been about macro. So three clear regimes which you can absolutely make out by looking at the numbers.
And any particular, out of curiosity, any particular drivers of those that you've seen from, sub factors that are driving those macro, or is it just kind of you're looking at it really culmination of almost all the factors together are really driving the Mag 7 at the moment?
So the what I'm showing you about the macro is very much about all the factors, and you obviously have big moves in certain factors that you've seen, such as credit spreads and risk. But in terms of the sensitivity, and this is what you want to understand on a go forward basis, there have been some big regime changes in the Mag 7, and here are the key ones. The Mag 7 is now looking for lower inflation, lower yields, and somewhat lower real rates as well. This is totally different from what we've seen for several years now. And what you have is a completely different regime where the Mag 7 is looking for a very different type of macro environment, a low yield, low inflation environment with real yields perhaps not quite as high as they were in the past. So that's actually quite interesting and quite different from what those stocks have been looking at previously.
That is interesting, right? I mean, people thought of the Mag 7 as being in some ways kind of a defensive posture, right?
Exactly.
Cash rich, right? Continuous growth, secular. But what we're hearing right now is that they're actually becoming more macro sensitive, is what you're saying, right? And really maybe aligning more with the broader market picture. And so to that extent, that does make sense. Those sensitivities would drive more macro movements in their security prices over the coming months.
Exactly. So, I mean, you can think about it as, if they want lower 10-year yields, well, maybe that's to do with the fact that people want to be able to get a bigger terminal value, because lower 10-year yields means a bigger terminal value. So that's a very traditional technology outlet or valuation dependency. And perhaps that's what we're beginning to see in the Mag 7.
The AI halo. maybe wearing off a little bit at the moment, right?
Maybe people need to think about good old valuation one more time.
Just about, right? Just about. It's been a very interesting ride, and I think probably a lot of investors would love to see a little bit more valuation discipline in the Mag 7 going forward. Well, this has been very helpful. I think this really you've been able to give us multiple perspectives, right, on both at a market level, at a sector level, even at a category level or a group level like the Mag 7 from your risk model. I think we're obviously very excited to have it integrated into Omega Point and continue to add value to the community together. And yeah, appreciate you coming on the podcast.
Not at all. Thank you very much for having me on, Omer, and we look forward to working together with Omega Point also.
Wonderful.